Hey, welcome to Access to Justice. I'm your host, Evan Clark. My usual co-host, Heather Moellering, can't be with us today. Unfortunately, she was a victim of a hit and run today. So our heart goes out to her, and she said everything's fine, but we want to give her some time to recover from that. So Heather, we're with you. And we are joined today by a very special guest, Kim McDonald of McDonald Advisory. Kim is a financial advisor and insurance advisor with Raymond James Limited. Kim, how are you doing today?
Hello, Evan. Well, I think I'm doing better than Heather with her headache and her probably a whole pile of paperwork now, which is unfortunate. That's a bit of bad luck. And I don't think anybody likes to be involved in a car accident, whether it's a hit and run or any other form of it. It's just a big pain in the butt.
Yeah, my wife was rear-ended a couple weeks ago. And it wasn't like a high speed thing or anything like that, but she's got neck pain, headaches and stuff. So I called up my buddy, August Locke, who's a personal injury lawyer. And I said, all right, how do we maximize this opportunity?
Is that how lawyers do it? They're just like, let's litigate.
Well, no, it's not about litigation because it's not likely to litigate. And we wouldn't do it anyways. The insurance companies jumps in our shoes to litigate if they need to litigate, if the other person's not insured. So, but insurance companies, as you know, Kim, want to pay the least amount that they're obligated to pay. And so they've got their little tricks up their sleeves.
Yes.
To keep those costs down. And we want the opposite. We pay good money for that insurance and we want to,
you want to be made whole.
Yeah, absolutely. And so, we don't want to scam anybody, but, we want to be made whole is the right way to say it. Mm-hmm. So she's in, physical therapy and stuff and hopefully she feels better soon, but.
Oh gosh, I hope they all feel better soon.
I guess it's the season of car accidents.
And the season of taxes and the season of mortgages.
Oh, good segue.
Do you like that?
I was going to say top marks for that segue.
I can't waste that. I wanted to say something else, but we've got to use it. So we have with us today Jill, and she is Jill Moellering. Is that how you say your last name? Sorry, Jill.
Yep.
Should have checked that before we started recording. Jill Moellering. Thanks.
You can say my name however you want, really.
Right. As long as we don't call you late for dinner, that's the old saying.
Yeah, pretty much.
Yeah. So Jill is a fully licensed mortgage broker with Mortgage Architects, serving Albertans for over 17 years. She was born and raised on an acreage just outside of St. Albert and spent years working in a variety of financial related positions, both in Alberta and abroad, before stepping out as a mortgage broker. Her passion is helping people navigate the multitude of options when it comes to their mortgage and helping them feel completely confident with the product they choose. She loves answering questions, comparing rates and payment plans, and finding the best ways for clients to achieve their financial goals. And Jill has told us beforehand that she can talk for a long time about anything.
Yeah, so welcome to the podcast, guys. Buckle up, sit down, get on a long car ride, and we're going to talk about the most engaging and exciting topics under the sun, right? Which is the boring world of mortgage qualifying. Right?
No, it's not boring though, because right now this is so mortgages are a real topic of conversation because of all of the rate hikes we've had over the last 6 months. It's become people don't want to be talking about it, but they are, because all of a sudden their mortgage payments have gone up astronomically.
Yeah, 100%. And I think, for nerds like me, so, absolutely a total nerd of the mortgage world. It's finally we're like the superstars, maybe it's the everybody wants to talk to a mortgage broker. Nobody wanted to talk to a mortgage broker, in 2018. Right. But yeah, everybody this year definitely wants to talk to a broker. They want to know what their options are, coming up for their renewals, especially. I think, there's I'm not going to quote statistics that I can't remember off the top of my head, but it's an insanely high amount of people who took 5-year fixed rate mortgages that are coming up for renewal this year. So, and when they took those mortgages, their rates were 2.5%, 3%, right? In that range. Coming up to renewals, we're in the 4.5%, 5 to 5.5% range. So, bit of payment shock for a lot of people, just hitting that renewal time period. And then, so that has made this, my job maybe a little bit easier this year, right? In terms of the phone is ringing off the hook. But on the other hand, a little bit tougher because, the cost of everything has gone up, a little bit of payment shock for some people, trying to get payments brought down so that life is still a little bit more affordable, and shopping around to try to get people the best deal, best rates going. It's a little hard to sell somebody on 4.5 when they're coming out of a 2% interest rate, right? So yeah, I guess a little bit of challenge from that side. But yeah, I guess everybody wants to talk about rates, prime rate, inflation, what's happening in the economy, where do we think the rates are going, what's going to happen over the next couple of years. I don't have a crystal ball for a lot of that stuff, but I, like I say, I will talk about any of it all day long. So we could be here you guys will have a degree in mortgage brokering by the end of the podcast, right?
Excellent.
Right.
So I've got a question right off the bat that I just thought of while you were talking there, which is who's feeling the most pain right now, variable or fixed rate?
So interestingly, I think a lot of people would assume the variable, right? So for those that maybe don't know, variable rate mortgages are based on the prime rate, which in turn is based on the Bank of Canada adjusting the overnight lending rate to combat inflation. And this is what we have seen increase quite a bit over the last year. And so those who are in a variable rate mortgage, there are two different types of variable rate mortgages. One where your payment stays the same, but the portion of your payment that goes towards interest changes. And then another type where your payment actually changes. So we've seen a lot of people who saw all of their payment get eaten up by interest and then suddenly get hit with a bank saying, hey, you need to increase your mortgage payment when they didn't expect that. And then the other type where every, 2 months, their mortgage payment just increased again, and then again, and then again, and then again. And they kind of got sick and tired of getting the letters from the bank, telling them that their payment was going to be higher again, right? The counter to this is fixed rate mortgages are based on the bond yield, Canada mortgage bonds, and these are based on sort of, the market and the reaction in the stock market and things like that. So two different factors. And so everybody would assume right now that variable rate clients are the ones that have been hit or that are feeling the pinch the hardest. And it was interesting because we were talking to a lender the other day, and they were going through their book of business in arrears. So the clients that are actually facing foreclosure or default that are in arrears on their mortgage payments. And I think out of 30, again, I always get these stats told to me and then I never quite remember the exact number, but I think it was out of 300,000 mortgages or 30, I don't know. Anyways, there was like 100 that were variable rate mortgages, and it was less than 10% of their mortgages in arrears. So the mortgages that were in arrears were people in fixed rate mortgages. So I think the interesting thing that told us was, I wish I had the real stats. I wish I knew that question was coming before the podcast. I would have looked up the firm numbers for you. But the interesting thing that sort of told us was, if somebody's going to struggle to make their mortgage payment, they're going to struggle to make it regardless of the interest rate. It doesn't matter that their mortgage was at 1.9% or 2% at a 5-year fixed. They were still struggling to make the payment, right? And even right now, I can tell you, I've just reviewed 2 deals for some refinances, some clients that are in some pretty tough positions. Their current interest rates, 1.8 and 1.9% in fixed rate mortgages. So while we would assume that the people feeling the pinch more are the ones whose payments increased, it does tend to be that the ones I think right now who are going to struggle the most are the ones that are, they took a fix. Maybe they were first-time buyers. They were a little bit more conservative. They bought at the maximum end of their budget, something like that, right? And then the other piece to that too is they're the ones that are going to feel that payment shock the most coming into their renewal. Because if you've got a mortgage rate of 1.8% and your payment is $1,200 a month, and you come to your renewal and now suddenly your interest rate is 5% and your payment is going up to close to $2,000 a month, that's a really big moment of shock for you from a monthly affordability standpoint, right? There's a little bit of false sense of security, I think, with fixed rate mortgages, in that you're like, oh, my payment is set, it's this for 5 years. And then you go out and you finance a car because that's affordable, or, you pay for extra things, right? Whereas on the variable rate mortgages, a lot of those clients, they were sort of prepared for some flexibility. They maybe didn't max themselves out, or they've seen that payment increase. They've sort of eased their way into it. So it's not going to be as much payment shock for them when they hit their renewal.
Now, did you know that, Kim, that fixed rate mortgages are tied to bond yields?
Mm-hmm.
I didn't know that. I just assumed that they're all tied to the same interest rate, not to bond yields. And bond yields, I don't follow them closely, Kim. I'm sure that you follow them more closely than I do. Have been a little crazy this last year, haven't they?
Yeah, essentially, people need to pay more on those income payments. That's why it's called fixed income. So as interest rises, bonds have to pay out more. Otherwise, people wouldn't buy bonds. They have to be compensated because they do take a little bit of risk buying bonds versus a GIC. So yeah, just it all ties together. The mortgage world, the bond world, they're all very heavily tied together. And then layer on psychology, which Jill was sort of heavily referencing. There's a lot of psychology behind spending behaviors. And I think lenders have a tricky job trying to suss out when people are asking, should I do variable or fixed, trying to suss out what those personality types are. Will these people be able to handle surprises down the road or not?
Yeah, this fixed obviously means fixed for now, not fixed forever.
Yeah.
It's just a variable, but on a slower burn.
And the interesting thing to this too is if anybody recalls the stress test that came out, right, back in 2017, we've already stress tested people's interest rates at 5.25% or higher over, the last 5 years and 6 years. So for those clients who do have a 1.8% or 1.9%, they qualified at a higher interest rate, assuming that if interest rates went up, they would still be able to afford their mortgage. But this, of course, was based on their situation at that time. And, and when we talk about consumer spending habits, just because they could afford the mortgage at that time, stress tested at 5.25, even though they're coming up to the renewal and the rate might be 5.25 when they come to their renewal, in the meantime, they've had another kid, they've got another kid in daycare they got to pay for, they bought a new car, that they're financed, right? Their spending habits have changed since they were stress tested for that mortgage. So, a little bit of payment shock, a little bit of change in habit over the last 5 years or that time period that they've been in that mortgage. But in theory, they should be able to afford it. We qualified them assuming the interest rate was going to be higher, but that doesn't necessarily mean that on the spending front, that they're still in the same position they were when they bought the house, right?
Right. And
inflation is a bit of a hard lesson to learn, right? A lot of people didn't really understand inflation because it wasn't an issue for the last, several decades. So,
when did we look at inflation in the media ever?
Mm-hmm.
It's like suddenly it appeared, and now, everybody's talking about inflation, and nobody even knew what inflation, definition of inflation, 2 years ago, nobody had any idea, right?
Mm-hmm.
Yeah. Well, the last time we saw, I believe the last time we saw inflation or interest rates getting up to where they are now was quite a while ago. I know that in the 80s, things got pretty crazy. You could get a GIC in like double-digit returns in a GIC, which
the next closest time frame, and this is one that's probably the toughest for a lot of people to swallow, and this will be mostly because of age groups and demographics of people and when they started purchasing. But the next highest time that we saw prime was actually in 2007. So it wasn't that long ago. Prime was at 6.25. Currently, prime is at 6.7. So we are a little bit higher than we were in 2007. If anybody remembers 2007, I don't know how old I was. I was my 20s. I'm sure I don't remember it, but times were good, right? Things were booming. The economy was doing great. Houses were expensive. I know we've got clients now who bought houses in 2007, and the house is still worth the same as it was in 2007, right? Values were high. They came down. They're now kind of back up, right? So 2007 was a pretty good time. And what happened immediately after that was the financial crash in 2008, 2009, interest rates plummeted. It did take quite a bit of time. We saw prime drop down to 2.25 during 2008, 2009. And it actually took 10 years for prime to get back up to partway where we were. So prime in 2019 was at 3.95. We were trending in 2018 and 2019 on that sort of increased prime front a little bit, but that was a really strong economic position for us to have prime around that 3.95 mark. In 2018, 2019, we were kind of creeping up. And then of course, COVID hits and here we go back down again. And then I think the part about this that has been the most dramatic or the most shocking for most people is that we went from, 2.5% prime to 6.7% prime in a year or less than a year, right? And that for sure has been the piece that I think most people have just been like, oh my God, right? It's not unheard of that prime has been at 6% or 4%, right? Like this isn't an unheard of position for us to be in. And it's not like we're replaying the 80s where prime, where interest rates were in, like you said, the double digits. But
it's the velocity.
Yeah, it's a lot to adjust for in a year, right?
Yeah. I mean, you just talked about how mortgage payments could be almost doubled based on the change in interest rate. And that's for anybody that's barely in a house or barely got their, has their mortgage payment in their budget, that can be insurmountable. Really. Yeah.
And I think what, interesting too, is a lot of people did their budget based on, especially people who bought in 2020 and 2021, when you're getting an interest rate that's 1.5%, you're doing your household budget on your payment. You're not really thinking or doing your budget on what would my payment be if interest rates were normal, right? Because 1.5% and 2% rates are not normal. That, mortgages were on sale for 2 years. They're not on sale and they're not going to be on sale ever again, right? We might see the rates come back down into the 3.5 range to the 4.5 range. That may be a good position for us to be in or an average position for us to be in. But when people were taking their mortgage payments at 1.5 and doing their budget based on that assumption, it was hard. I think it's tough because a lot of people didn't really think about the fact that that's not what your rate is going to be for 25 years. You might get a sale on your mortgage for 5 years, but your payment will be higher, right? And so again, I mean, it's the year of payment shock. It's definitely a conversation that I've been having with a lot of people. They're coming up for renewal. They don't understand. They've paid down their mortgage and they're like, I owe less on my mortgage and I have less, but my payment is higher and I don't get it, right? So that's definitely one big conversation that we've been chatting about a lot this year so far.
Jill, have you noticed that the lenders are softer in terms of conditions moving forward because they don't want people to walk away from their debts and their houses? Have you experienced any flexibility that you haven't seen in the past on that front?
In terms of the lenders working with clients, there's always been our lenders have always been really good at working with clients to help them in situations where they are struggling financially. We've seen some of the lenders doing amortization adjustments, pushing out amortization on the mortgages and things like that to help get people's payments down. Even all through COVID, we saw deferrals and things like that. Not to jump onto another topic entirely, but the deferral aspect is also a piece that's hitting us now because a lot of those people who did deferrals during COVID, they have to make up that extra payment. And now they're getting to the end of their term and they have these extra amounts being tacked onto their balance and their payments are getting adjusted because they actually owe more money because they deferred for 3 months and they didn't make all those payments. So there's a little bit more coming into play here all at the same time. But yeah, we have seen our lenders that are willing to work with the clients to help them in, especially for clients that are suffering some of that payment shock. But in terms of qualifying a little bit stricter. Lenders are maybe a little bit more I don't know how to say the right word to that, but on edge, maybe they're a little bit more cautious. There's a little bit more risk involved, particularly in some of, certain communities across the country. Ontario right now, pretty high risk there. They're seeing valuations come down. Here in Alberta, we've tended to have a little bit less risk tolerance with our lenders in general, just because Alberta does tend to have a pretty high foreclosure rate. It's the highest in the country, in fact. And so we've already had a little bit lower risk tolerance here in Alberta, and our values have already kind of done some fluctuation and stuff. So I think here we're pretty used to it. But in some of the other parts of the country, like Toronto, they're not used to paying to valuation drops, right? For their market, valuations have just gone up and up year over year. So for them to be in a position right now where, people bought houses in 2020, 2021, and they're getting to the renewal, maybe they were in short-term private financing, alternative financing, and things like that. They're getting to the renewal and the property's not worth what they owe on it. And, so we've definitely seen some leeway with lenders that are renewing and those kinds of options. But we've also seen some lenders that are just like hard nose, give us our money back. They want their equity out, especially in private lending situations.
So what does that actually look like? So somebody can't pay their mortgage, the lender says, you're out of there. Do they just literally hand the keys over to that lender, pop it in the mail and walk away, and the lender just puts that house on the market?
It depends on the type of, first it depends on the province. Different provinces do have different foreclosure laws, but it also depends on the type of the mortgage. So for example, if you purchase the home with less than 20% down and your mortgage is insured by one of the three main insurers, right? CMHC, Sagen, Canada Guarantee, that insurance is called default insurance. So what happens in that situation is you've paid that insurer premium, your mortgage is insured, so that if you were to foreclose on the mortgage, the lender doesn't lose any money. So what happens is the insurer steps in and takes over the foreclosure process. So they're the ones that are going to have the property, they sell the property. If there's a shortfall in that sale, they do come after you and you will owe that short sale. A lot of people file a consumer proposal or a bankruptcy to manage that. And then, of course, there is a credit rebuild time period, before you're going to be able to purchase again, 5 to 7 years down the road, depending on how long it takes you to pay that off, right? So, default insurance is going to manage that in one way. In Alberta, if you're in a conventional mortgage, there's a sue or seize policy. So if you do foreclose on a property here and you hand in the keys, if they sell it in a short sale, they're not necessarily coming after you for the short sale. But other provinces, that's not necessarily true. I'm not an expert on real estate law in those provinces, but they may still be able to come after you for any short sale in the property. And of course, which would result in you probably are filing a bankruptcy or something like that to avoid paying it, right? So it can have some pretty serious consequences for sure, which is one of the reasons, why we want to make sure that when you're looking at a purchase price, you're looking at a property, it's affordable for you. It's affordable for you at this budget, but it's also affordable for you if the rates do go up a little bit, because you want to make sure that you can manage those payments, never maxing out your absolute maximum. This is something that does come up with us a lot, where someone wants to spend a certain price point and they can't qualify it for themselves. So they bring in a cosigner to help them qualify for a higher price point. The one thing that I usually recommend in those situations is you have to think about the fact that your cosigner is not paying your mortgage payment, right? So just because your cosigner is helping you get a higher purchase price, is this still affordable? So we really want to make sure that clients are, doing the math on affordability. Just because they want to spend that much doesn't mean they can actually truly afford that much and still have that buffer, so that they're not in that situation. And definitely a conversation to be had if you are somebody that's more in the alternative or private lending space for whatever reason, there's a lot more risk that does come from that type of lending, right?
I had a client not too long ago try and purchase a house. He's very well capitalized, but he's retired and doesn't have the income that the bank's looking for, even though he's got piles and piles of money. When you were talking about co-signing, do you ever see that retirees have their kids co-sign with them just to get to be able to qualify for those mortgages now that they're retired?
So actually, I do a lot of retirement planning for my clients. So this is one that I really actually enjoy quite a bit. So thanks for bringing that up, Kim. Interesting situation. I mean, and this is one that can be really frustrating for people who are at that retirement age, because the last time they got a mortgage, was probably back in, the 90s or something, where you could literally walk into the bank branch. You knew the branch manager, you slapped down a copy of your pay stub and they handed you the money, right? And now, we've got debt service ratios and qualifying rules and stress test and, all like so much more paperwork required. And it can be really frustrating for people who are, they were used to it, in the 80s or the 90s when they got their first mortgage, it was easy, right? So that can be a little bit of a challenge for them. But we do have options. So particularly your client who's got boatloads of money, we have high net worth programs that we can qualify the clients on with, where it doesn't matter what their income is. So we've got clients who've got minimum 250,000 in personal like assets in the bank. To qualify for high net worth. Some lenders will look for 500,000 in liquid assets, but minimum 250,000. So if their client does have more money in the bank and they actually just don't want to pull that money out, they want to finance instead because they're trying to, they've got that money invested and they don't want to pull it all out all at once. We can qualify them on having that money in the bank under a high net worth program where the debt ratios don't actually matter. So as long as the client can show that they have the funds that if they needed to, they could pull those funds to make the payments, then we've had high net worth deals with 200% debt ratios on them before. So we don't actually have to bring in co-signers in those situations. There's also products for retirees. If you're over 55, there's reverse mortgage products and things like that. So where you can finance and do equity takeouts of your property without having to make mortgage payments. And those types of lending situations they don't care about your debt ratios because you don't have a mortgage payment to make, right? So there are ways to be able to tap into that equity without having to necessarily divest any investments or pull out of RSPs and have tax implications for that. So there is definitely lots of ways that we can help different programs. But one of the things that I do usually talk to, especially if they're a little bit older in retirement, is depending on how many properties they have, they might actually want to have one of their kids on that mortgage with them in case something happens, right? So, power of attorney type situation, if there's, heart attack, stroke, or death, or things like that. So there can be, advantages to having one of their kids on their mortgage with them, especially once they get a little bit older, into their 80s and things like that. So we do a lot of planning with people from that side, but definitely one of the things that we look at when we're talking about adding the kids to co-sign for the parents, which we do as well, is you really want to make sure that the kids know that they have to fully debt service their parents' mortgage now on any of their future mortgage applications. So if they haven't set themselves up with their own home, or if they're thinking about buying a rental or something like that, there are definitely considerations that we do take into account when we're looking at a file like that, just to make sure it makes sense overall.
Yeah, I would just say you can have a power of attorney without a person being on the mortgage. So if that's actually the concern, you would just get a power of attorney. If you're concerned that sometime in the future you may need help with managing your finances because you're now incapacitated, then a power of attorney is the right thing for that. And you can deal with the mortgage, you can deal with anything with the power of attorney. Yeah,
the only tough piece to this that I'll counter on that is getting new financing. Not a lot of lenders will allow a power of attorney to apply for financing on behalf of somebody else. So there can be, although I understand that they absolutely can do it, there are a lot of restrictions from the lending side. So if you're looking to apply for financing to, say, keep somebody in their home longer, you need equity out of the home to do renovations, put in a ramp, bathroom renovations, or whatever. If you're trying to apply for that under a power of attorney, most lenders aren't going to take it. So, I know. I hear what you're saying. I don't mean to. Yeah.
It doesn't surprise me because, I think if there's one thing that financial institutions are good at, it's at creating their own red tape, making things more complicated than it needs to be, and which is exactly that, because a person with a power of attorney could sell the property and clear out the financing and has the legal authority to enter into a mortgage agreement, even if the lender won't do it. It doesn't matter that they have the legal authority, but they do, at least in Alberta. I can't speak for all provinces, but they're pretty similar across Canada. But I mean, I have all kinds of concerns with, so if you're going to add somebody to a mortgage, my legal advice to them would be, well, also get added to the title, because of that very reason, that you're now on the hook for the mortgage. Jointly is usually how they do it. So, and that means the bank doesn't even have to go after the other person. They can just go after you for whatever they want to do. And so if you don't also own the underlying security, then that's a huge risk to take.
Yeah, so most mortgage lenders, when we add someone as a co-signer, they want them added to the title. If we are adding them as a guarantor, which is a little bit of a different situation, this is where somebody can be on the mortgage but not on the title. But typically, if someone's going in as an actual co-signer, they are on the title and they are fully on the hook. That mortgage will report to their bureau and everything like that too, right? So
then that creates another problem, because if you're on title, that means that if you're on title but you don't really own the property, which is kind of what we're talking about. Like kids, they don't really own the property, but they're on title to help the parents to get approved for the mortgage. This is the kind of situation that we're talking about. Legally, if you're on title, you could block anything to do with that property because you have to sign. And so you could block refinancing, you could block the sale, whatever. And often people get added to title and the mortgage when it's like they're also kind of planning for their estate planning situation where they can avoid probate if they're on as joint tenants. When the person dies, then they just get the property and everything just carries on, and you're able to avoid that, which is good. That's a good thing. But in order to do that and have it play out the way that it should, which is mom or dad, or both of them, whose home it actually is, can do whatever they want with the property, and the children don't have a say in it. They just get it if they die. In that case, there needs to be some other kind of an agreement, because what's actually happening is there's a trust created, because the children have legal title, but they don't actually, it's not theirs, it's really their parents. So in that type of a situation, you can enter into, there's lawyers deal with this in a couple of different ways that I'm aware of. The way that I like the best is they enter into what you would call an off-title agreement. That basically says, the children say, we know we're being added to title, but it's really for convenience for estate planning purposes. And also because we are securing the loan, helping mom and dad with the loan. So if anything happens, if the property sells, we're protected by that mortgage agreement as well. They can't just keep coming after us. But it also says, we have to sign anything that mom and dad want us to sign because they want to deal with the property. They can sell it if they want, that kind of thing. If you don't have that kind of an agreement, then there can be real problems. And when people are winding down this life thing, which happens, we all die. But when we're getting,
I won't, but some of us will live forever.
I probably will die. And so when you're getting to that point, it sometimes brings out the worst in people, and people don't act the way that they said they would act.
100%. And we do see this a lot. I'm not trying to interrupt you here.
No, that's okay. That's what all I wanted to say. Like, that was just flagging some things that, because a lot of times people don't think through all of those potential consequences. They just think, we have a good relationship right now, everything's going to be fine. And of course the kids will sign whatever I want them to sign. And then, if they don't have an agreement and then the child won't sign, well, now it's too late.
Yeah. And in this actually works both ways. And I actually see it cause bigger issues. The other direction is when parents co-sign for their kids. But 100%. And, when we talk, and this is why I say, like, I like estate planning in terms of mortgage finance. I like this. I like helping people navigate this kind of stuff, setting them up for their retirement in advance before they retire and things like that. But when we do talk about bringing the kids on, it is a lot of the time, it's the estate planning situation for that probate situation. But I'm not I want them to talk to their lawyer. I want them to talk to their accountant. I want them to know about capital gains implications. What type of property is this? Any of that kind, inheritance, whatever, right? I'm not advising them on any of that. So, but I like being part of that solution for them and helping them get set up properly, because I think a lot of times, we've got people, they don't even know that these are options that they can explore, right? Or they get to the end of life and they're in maybe their last 10 years and they don't know, and it's sad, but we see a lot of people struggle in their pension incomes and retirements. Cost of living goes up and before you know it, they've got a lot of debt, and then they're getting to the end and struggling with those payments and things like that. So I do enjoy that aspect of the business, is helping people set that up. But to your point, I see this a lot more on the flip side, parents co-signing for the kids to buy the first house, right? The kids need those parent co-signers maybe for credit support on the deal if they don't have a really strong credit bureau themselves or strong credit history, or if they don't necessarily qualify for the purchase price that they're wanting. And so we're bringing in their parents are co-signing on that purchase for them. And I've seen quite a few times, I had an email in my inbox last week. Dad co-signed for them last year. Things are not great with dad. They want dad off of the mortgage of their house, right? Because, however that relationship has broken down or what that situation is, it also causes issues when we've got other siblings and other family members. I've had files where we've had grandparents co-signing or older parents co-signing, and one of them passes away. And then you've got a situation where the rest of the family is trying to maybe clean up the estate, and they can't because the mortgage, dad's name's on the title of a house or something along those lines too, right? So, it does it goes both ways, but I do see more issues where the parents want to be a little bit more controlling about what's happening with the property or with the house, and the kids want their freedom. And so some issues there. Kids want to refinance, they want to build an addition, they want to sell, they want to do whatever, and the parents don't agree with their plans, and now their parents have to sign because they're on that title as well, right?
Yeah, so be careful. Don't just throw people onto title because, the whole thing, the whole thing about buying a home is, in my opinion, has become a little crazy. Like, people feel a pressure to buy a home, and you've got to do it. And if you don't do it, you're somehow not an adult or something like that.
Yeah, it's the American dream, right?
Yeah.
And Canada has the highest home ownership rate per capita of anywhere in the world. We own more homes than any other country in the world. We rent less than anywhere else. And it's we've sold the American dream, right? You go to school, you graduate, you get a degree, you find a partner, you buy a house, you get married, you have a baby, and you do all these things, and probably not in that order, and that's part of to being an adult, right? You're 20 years old and you're like, what are we supposed to do? We're supposed to buy a house, right? And there's that pressure to rush into that situation. And it doesn't have to. I was in my 30s before I bought my first house.
I'm 41 and I'm rent, and I love it.
Yeah. So I've had conversation with a couple of people in the last month where I've said, why do you want to buy so bad? You're paying $1,000 a month in rent right now. You can't, and they wanted their budget to be around that. And, when you're talking about that monthly budget, well, if you want to be within $1,000 a month, you're probably looking at a $60,000 property. It's got condo fees. It's probably an older property. There might be a special assessment. Those condo fees might go up. You've got property taxes. There's probably repair, maintenance, things like that you're going to have to deal with. If you're renting for $1,000 a month, let your landlord replace the fridge, because if your fridge breaks and you own, that's more than your rent to replace your fridge, right? So definitely there are some advantages. to renting. But I mean, I wouldn't be a mortgage broker if I said that everyone, I'll call you after, Evan, and we'll get you pre-qualified. We'll get you into a house, right?
Yeah. No, I'm good for now. But I think that's kind of a lot of the issues we've been talking about so far are things like, people running up against the limits of their budget, and they pushed it to get into the home. And sometimes that's a first time buyer just thinking they have to get into a home. Now, in some places like Toronto, Vancouver, Vancouver Island, it perpetuates that thinking, or it has perpetuated that thinking, because the market's done nothing but go up. It's just gone up for almost straight for 20 years. Because they did have a little bit of a dip perhaps in 2008 as well, but it didn't last for long in Vancouver and Victoria, which are areas I'm familiar with. They maybe had like a sideways bump for maybe a year and back heading straight up. Like sometimes 20% increases over a year. And so, okay, you get into a house there, you're seeing capital appreciation. In other words, you bought your house for $100,000 and then within a year, it's $120,000. So even if your mortgage is still the same, you've made $20,000 in a year. And there's no house in Vancouver you can buy for $100,000. So you paid $1 million, and within a year you earned $200,000 of equity on that property. Yeah. Or you bought it in the early 2000s, and so it was more reasonable, and now it's worth a few $1 million, and you can't really access it because you can't afford the mortgage payments, but you're sitting on this asset worth $4 million or whatever. And so, okay, it's like, yeah, if you highly leverage yourself in, pretty soon you're not highly leveraged anymore because the value's gone up. And so everything's great. Everything's fantastic. But if the property value goes down and you were super highly leveraged on the way in, that's where it gets tough.
And I think one of the bonuses or advantages that we've got here in Alberta, and I do work on files across the country. I've got a team of agents. I've got agents in Ontario, throughout Ontario, BC, Vancouver, the island, and here in Alberta, Saskatchewan. So we work on files across the country. And, and one of the interesting things that I always think is kind of great about Alberta is if you don't qualify for a $400,000 mortgage, you probably qualify for a $350,000 mortgage. You can still buy a nice house. If you don't qualify for $300,000, you qualify for $200,000, you can still buy a house. Like there's typically always something that's within someone's affordability range in Alberta, right? Condos, $100,000 condos, things that are nice and good condition, stuff like that, right? So there's small towns, you can buy an actual house for $100,000 in a small town, an hour's drive from the city, right? So that's kind of one of the nice things about Alberta. Where we tend to see people really leverage themselves are in areas like Vancouver or Toronto, where you can't get onto the property ladder unless you qualify for $600,000 or more. If you don't, we've had clients, school teachers, accountants, lawyers, working professionals, 2 double income households qualify perfectly, great credit, down payment, 10% down or whatever, and still can't buy a house because there's nothing for sale in their price point. And that is where I think there's a lot of pressure for people to kind of push beyond their limit and to get into a property, because you're right, they're seeing it's just going to be more expensive next year. Right. But I do like to, have people really think about what that cost looks like for them. And a lot of times people will say, I get a lot of those phone calls, like, when's the best time to buy a house? And I'm like, I don't know, when you're ready. Like, the best time to buy a house is when you want to buy a house. It's when you're ready to buy a house. There's the interest rates, they go up, they go down. The values of properties, they go up, they go down. I've lost money on houses. I've made money on houses. None of that you can't control any of that. All you can control is, can you afford it? Are you ready? Do you have the down payment? Are you in a position in your life that you're not going to move every couple of years, right? Are you trying to create stability in your life? Are you ready to purchase? That's the only part of the whole equation that you can control. You can't control government regulations, inflation, wow, maybe you can control inflation. Just stop buying stuff, guys. Like, stop ordering new couches and new cars.
Stop buying bread.
Nobody needs eggs anyway. But
the demand goes down for food, the price will go down. So just stop eating.
Just stop eating, right? That was my New Year's resolution goal. Just stop eating. I'm just doing my bit for inflation, right?
Nice. Yeah.
Jill, what do you find that, like on the psychology side of borrowing, what are some things that you notice with young people in terms of their lack of fear or too fearful to jump in and talk to somebody like you? Is there a component that you guys explore on that side?
I think that people are, like, it's literally split 50-50. They either are completely like oblivious of what their financial situation is, or they're like hyper aware of what their financial situation is. And, the oblivious to their financial system or situation are the ones that are just like, hey, let's go get let's buy that. That looks cool. Let's go, they're just like, yeah, we got 10 grand in the bank. Let's buy a house. Let's go after it. Right. The hyper aware, are the ones that are like, they've been saving for years. They're analyzing the markets. They're like, is this a good investment? And they tend to be the ones that are a little bit more afraid. It's interesting when I have introductory calls with clients and I usually ask, is there anything that you're concerned about on your credit? Do you know what your credit score is? The people who have good credit, they never know what their credit score is. And they're always like, oh, I don't know. I might have made a cell phone payment late like 3 years ago. I don't know. And then they always have like a fantastic credit situation. The ones that like, when I say like, what do you know about your credit situation? Is there anything I should know about? If they tell me their credit score, I know there's issues, right? They know that they've made some mistake. They got some debt. They're monitoring it. They're trying to get approved for more loans or things like that, right? If they're, there tends to be two totally different schools of thought there. The psychology of buyers is pretty interesting to explore. And I don't know if I would say young, like when you classify for young people and we're talking about first-time buyers, like, the youngest generation, I find, tends to be like a little bit more responsible than maybe like my generation. Our generation was just kind of like, oil money. We do what we can, like get the truck, get the RV, we're financing it all, like YOLO. Like, we want the big house, we want the big truck, we want the camper, we want the whole, that generation wants the whole thing.
And we want it now.
And we want it right now. And I don't care. Just what's the monthly payment? Okay, cool. Right. And I do find that the younger generation, these guys that they're coming up and they're in their 20s and stuff, they're a lot more savvy. They've been raised a little differently. They're a little bit more respectful of money. They've saved some money a little bit better. They're not financed out. You ask them what their vehicle is, and it's like they're driving a 2012 Toyota Tercel. They're not in the 2023 Dodge Ram that's 150 grand, right? Like they're planning a little bit more. So everybody always says like, oh, in my day, like when I was a kid, but actually I think like in my day when I was a kid, and for the record, I'm not that old, but like, I think we were the ones that were bad. Like I think that, anyway, our generation's doing a good job raising today's kids. How's that?
There's hope. That's great.
There's hope. Yeah.
Yeah. My kids I have two kids that are working, and one's 18, one's 16. They're better with money than I was at that age.
Yeah. But I think they save, they know, like they know how the world, they want nice stuff and they're going to save for it. Right.
I'm on them. So like, I'm going to take some credit for that because I'm their dad and I'm on them about making sure they're better than I was. But, and I was able to save when I was younger, but I also bought stuff. And actually a lot of the stuff that I bought when I was like 18, 19, I actually still have, which is very weird because there's not a lot of stuff I bought after that I still have, but I do have you're living in the past. That hoodie's got to go. It's been stained for years, Evan. It doesn't fit anymore. Really nice though. It's so comfortable.
You know what? It's the classic do as I say, not as I do mentality, right? Like, yeah. But I do think it's interesting seeing this younger generation. They're They got the different kinds of bank accounts. They're investing. They're in Quest Trade. They're in Wealth One, whatever. They're thinking about this kind of stuff, and they've got plans in place, and that's been really, I don't know, makes me feel like garbage about myself, right? When I was 18, I was like, travel, move around, spend all my money on airplane tickets, right? Like I never saved anything.
So remind me, were you not in Banff for a while, living it up?
Yeah. Oh yeah. I lived the Banff life. I was there for 8 years. So I went there when I was 18 and I left there when I got 8 years, I guess, 26, 27. And I remember the reason I left Banff was because someone said I was the company mom. And I was like, I'm 26. Like I'm 26. Like, but every year everybody's still 18, and I wasn't. I was getting older, and all the staff were 18 every year. So somebody called me the company mom, and I was like, peace. And then I was and then I went abroad and did all that, right?
But all those memories from traveling, those stay forever. They never.
You know what else stays forever? In money in your bank that's invested properly at 18.
Not true. It goes down. Inflation makes it worth less over time.
Yeah. You know what? So what you're saying
is those memories, they get better with time.
This is why our generation is financed out the nut, right? Yeah. I'm just kidding. We're not actually that badly financed out the nut. The world, our generation, everybody says that. We think about that a lot. I think the average consumer debt per household is around 25,000 or something like that. Alberta's the highest, of course, of anywhere in the country. But I don't 25,000 of average household consumer debt, not including mortgages, right? Isn't that bad? Again, nobody fact check this podcast for statistical accuracy afterwards, please.
Oh, isn't it?
I just say things so that they sound like they're true with enough enthusiasm.
I thought it was 90% of statistics are made up.
Of course. Yeah.
You're fine. So we've on this podcast before, we've talked about the spousal buyout program. You help people with that as well, right?
Yeah. So I do a lot of divorce financing, particularly in the last few years. COVID, I don't know. Either you loved your spouse during COVID and it was great, or you realized that you have nothing in common and you don't want to be in the same house as them for 2 whole years straight. So a lot of divorce coming out of COVID. So the spousal buyout program in and of itself is a little bit of an interesting financing product. And there's a little bit of technicality to explaining that, but in case you guys want to nerd out with me here.
You don't have to go, like we've already had an episode where we got into the details, but maybe you can just share like a refresher. So anybody that didn't listen to that episode can get a taste and go back and listen. And anyone who did listen can have their memory refreshed.
Yeah. So, when it comes to divorce financing, there's a few different ways that this goes. You're either buying somebody out to stay in the house, you're selling it, you're separating, and you're buying 2 new properties, kind of thing. And the amounts that you're going to be buying each other out of are going to vary, case by case, depending on what that asset breakdown looks like in your relationship, right? Maybe you're paying out more in RSP contributions, or moving those over, or bank account savings, than buying out equity of the house. Who knows, right? There's definitely different ways that gets balanced out with every situation. When it comes to separating the asset of the house and buying somebody out, the first way that we're going to look at that usually is to see if we can just do a regular refinance. Can we get enough money out of just a refinance on the property in order to pay out the X, right, and buy out that property? But when we don't get enough money out of the property on just a standard refinance, because on a standard refinance, we can only borrow up to 80% of the value of the property. So if we need to go to a higher loan to value, and higher, if we need to get more money out than 80% of the value of the property, this is where we look at the spousal buyout program, where we can go up to 95% of the value of the program, but you do have to pay to insure that mortgage. So I know earlier in the podcast, we talked about CMHC, Canada Guarantee, right? That default mortgage insurance. So when a mortgage is what we call high ratio, so this is where you owe more than 80% of the value of the property, that mortgage does need to be insured. And so the spousal buyout program is an area where we can help clients get to that 95% equity stake, but effectively it's one partner buying the property off of them and their ex, right? So, so that they can get back to that 95%, get the equity out in order to pay out the ex, but they do have to pay to ensure that. So, yeah, without getting too much into the details on it, it is an option to be able to finance back up to 95%, but there is stipulations with that program around how that's outlined in your separation or divorce agreement, and stuff like that. So.
Now, along that same train of thought, spousal support, which is a way that in divorce, we kind of rebalance the income or move income from one person's income to the other person's income. So increase someone's and decrease the other person's. Does that count for income? And what about child support? Does that count as income?
Yeah.
For the purpose of getting approved for mortgage? And how does that work?
So sorry, keep going.
No. And how does that work? That's it. That was.
Yeah, I know. I keep jumping in and then I'm like, oh, you're not done yet. Sorry. I'm bad for that. So yeah, we can use alimony and child support as income. We can also use child tax benefit. There are a little bit of restrictions when it comes to ages. So we're not going to use child support for, a kid that's 18, right? If it's the last year or they're going into university and they're maybe only getting that support payment for a couple of years, we may get to use it on some exceptions. We're not, but that's, this is typically for, kids that are younger and stuff like that. Right. So, but we can look at using that as income to help qualify. So the one partner who's receiving the income, we can use that to help qualify them for a mortgage. But we also have to be cautious when you're negotiating this kind of stuff, because we also, for the person paying it, we have to account for that as a debt payment for that person paying it. So I've seen, divorce situations where the one partner is paying the other $7,000, $8,000 a month in support payments. And when you add a $7,000 or $8,000 a month debt payment to their personal liability, it doesn't matter that they make $300,000 a year. They can't buy anything, right? When they're paying out $7,000 or $8,000 a month, which, is $80,000 a year effectively or whatever of income, right? When you're paying that much out, we don't just look at somebody's $300K and say, oh, okay, well, we're going to take 80 out of that because you pay that in support. We can do that with alternative lending, but we can't do that with our traditional bank lending. And so if you're putting a $7,000 a month payment into someone's liabilities, you're now in a situation where one partner that's, stay at home with the kids making $80,000 a year in support payments qualifies for a pretty nice house, right? They can qualify typically $400,000 range, nice house. And the partner paying it, despite making $300,000 a year, can't afford to buy a house because unless they have 20% down and goes into, the alternative lending space, which comes with higher interest rates and things like that, right? So there is something that we do want to, we do like to kind of keep in consideration when those situations are getting negotiated to make sure that both parties in the divorce can move on with their lives, right? And can afford to move on with their lives.
What does that timing look like? Like, when would a lawyer consider bringing in a lender when negotiating those support payments?
I like to do pre-approval for the clients before they finalize their separation agreement, to make sure that they can move forward with what they want, especially if they're doing a spousal buyout. Because if you're incorporating, into your separation agreement that one party is taking over the property out of the other one, and then the amount that they're going to be paying out, we need to know that the person taking over that mortgage or taking over that property can qualify on the income that they're getting in order to do that, right? So I'd like to do that pre-approval before they sign that separation agreement. Oftentimes, we'll do it in conjunction. So we're almost at, agreement signing stage. Everything is sort of drafted up. We've done the pre-approval. We know that they're sort of ready to go. We'll submit live to a lender, get them financing, so that they know that once they sign that agreement, that they can, obtain that financing. And usually the financing is conditional on the agreement being signed. So we like to kind of work hand in hand with the lawyer, with their accountant, whatever, while they're in that stage, just to make sure that, yes, everybody can move forward. We qualify for what we want. I'll give you an example of this. I had a client who they had drafted up the agreement, the separation agreement, as child support and alimony. And the child support payment, I'm going to make up numbers here, was, $1,500 a month, and the alimony was $2,000 a month, right? And then
hold on, Jill, before you go on, I just have to say, alimony is an American term. We don't use that here. It's spousal support.
spousal support. I'm sorry.
I knew Evan was going to come in on that.
I'm sorry.
I just knew it.
That's funny because we call it alimony all the time in the
It's
morning.
wrong.
Okay.
But
I will stand corrected, and I will shamefully change my.
I mean, you say it because everyone knows what it means, and so maybe I'm just being extra.
You know what? I'm gonna write that down, and I'm gonna put I'm gonna try to change my terminology here.
It's fine if you don't. People, all that's important in communication is that people understand what you're talking about, and I think when you say alimony, people understand.
Right? Yeah.
But if you're looking up something about alimony in Canada, it doesn't exist. It's spousal support.
There you go. Okay.
Sorry for derailing you. Carry on.
All right. Well, hey, derail all you want. This is your podcast. So I had this client where the agreement stated spousal support, $2,000 a month, child support of $1,500 a month. And then when we got to the application stage and, pulled his bureau, we had the mortgage for the house that the ex was staying in, and the mortgage payment was $2,000 a month. And then we had a vehicle loan on the credit bureau, and that was the ex's vehicle loan, and it was $1,500 a month. And because that's reporting to the client's credit bureau, we needed to debt service the mortgage payment and the car loan, and we also had to debt service the spousal support and the child support. And so the numbers lined up, and and so we went back and asked, like, why do these numbers line up? And they were like, well, actually, it's because I'm just paying the mortgage and the car payment. And that's the agreement, is I'm going to make the mortgage payment and the car payment. And so the lawyer was able to redraft the separation agreement to actually state that the one party was going to make the mortgage payment and the vehicle loan payment instead of calling it, support payments, because now we were able to move forward and actually purchase with only needing to debt service the existing mortgage and the car loan, as opposed to needing to basically double up on those, which would have made the ex not able to qualify for anything at all. Right. So, so good to check in, I guess, in terms of terminology, maybe, or how you're drafting that up. I've also had some situations where people have come to me and asked if it was more beneficial for them to take a lump sum payout from their ex as opposed to receiving support payments. So in that situation, the party didn't have any income, they didn't work, and getting a big lump sum payout of $100,000 was great, but unless you're buying a house for $100,000, you have no income. You don't qualify for any financing. So in that situation, that client, it made more sense for them to actually take, they took a partial payout, so they had a down payment, and to actually negotiate for a spousal support payment on a monthly basis so that we actually had income to help them qualify for, so that they actually could then get financing, right? So lots of different things that can be considered when going through that situation, different ways that it can look on paper to a lender to be able to actually qualify for financing and moving forward.
Let me give you an example, Kim, of what it looks like if you don't have the mortgage broker involved at the stage as Jill described. So I have a file, and don't get me wrong, not much would have changed here on this file, but let me just tell you what happened. So I was on for the guy. He's older, wanted to retire, but he's not retiring yet. He's working in the oil patch, making a lot of money. And the wife is getting just 50% of his paycheck. And that's what the spousal support is. It's not a set amount. It's 50% of his paycheck. And so every month they do the math and he sends her 50% and they're happy. They've got a condo in their names and they have their home in their names. And part of the agreement was he's going to get her off the condo and they're going to sell the home. Well, when this was all signed up, probably last summer or something like that, it wasn't a great time to sell. So they're like, let's just not sell the house for now. And so now he's trying to refinance the condo, but he's still on the mortgage for the home, for the family home. And he's not paying her a set amount in spousal support. He's paying her 50% of his paycheck. And so I hooked my client up with another guest. And by the way, Jill, you are in very good company we've only had amazing mortgage brokers on this podcast, and you're one of them. So welcome to the club. I hooked our client up with another former podcast guest, Lucy Ruda, who, by the way, apparently was amazing and did a great job, but wasn't able to get it done because nobody would provide the lending because his debt service ratio just didn't make sense. It couldn't work. He couldn't qualify for that mortgage alone. So now, what does that mean in reality? Because basically my guy had, like, I think it was 90 days to get her off the condo. We're well past that. And so technically he's in default under their agreement, but in reality, like, she's not suffering any damage because, he's still paying the mortgage for the condo. And, the plan was that they sell the house, and she decided she didn't want to sell the house, which is fine. Like, nobody's upset here, I don't think, but it's still kind of a precarious situation. And if they weren't okay with each other, this could be a real problem. There could be civil litigation and all kinds of expenses with this. And, things didn't go quite as planned. And my guy didn't know that he wouldn't be able to just get her off the mortgage, because why wouldn't he be able to afford it? He's affording it. So why wouldn't he be able to? He was the only one making money. Anyways, now he's got to sell the condo, which he's fine. He wants to anyways. He doesn't want to hold on to this thing any longer. And that will be fine. But it could have been a lot worse than it turned out to be. And if they knew that before signing the agreement, they could have changed the agreement to make sure that it was going to work.
Yeah. And I think most people, when they're separating too, like most of the situations that I've come across, paraphrase here, just make a general assumption, right? Most people don't want to destroy their ex's life, right? Maybe they do. I don't know. Maybe I should be a family law lawyer and I'll realize that maybe they all do. But most of the clients that I've worked with, they're amicable. They want their ex to be able to move on. Everybody wants to they want to work together to get this done, and they want to be able to do it as adults and move forward and know that, that everybody can afford to carry on in life, right? Nobody wants to destroy their ex's life, right? And, you've got kids together, they're a parent, whatever, right? So there can be a lot of emotions that go through at that time period. But I don't think that, again, maybe I'm super naive, but from the people that I've worked with, general malice is not one of them. So it's not like you're intentionally trying to, hurt your ex's opportunities or chances at moving forward. But it's just a matter of terminology, right? Or the way that something is structured to make sure that it's what's beneficial for everybody, right?
Yeah, I think generally if they're entering into a separation agreement, it's because they at least realize that that's the best way to handle the situation economically for both of them, for themselves. They at least recognize that. And so in order to get it done, there has to be some give and take, and there has to be some kind of, you have to agree on things. So it's just a matter of you need all the information in order to make a good agreement. If you're missing information, then you can end up with something that's not fair. It doesn't work.
Yeah. No, 100%. And you know what? And he has to sell now because he's got to get her name off of it. And what's his likelihood of getting approved for another mortgage? He can't refinance this one. He's probably not getting approved for other financing to buy something. He's going to be going into renting, that kind of stuff.
Yeah, he's living in a trailer in the oil patch. He's fine.
Oh, yeah.
and then at his girlfriend's place when he's out of the oil patch, but most of the time he's in the oil patch. So my client's okay. I'm not worried about it. He's going to be fine. But you're right. Other people it could be a lot worse. That's what I'm saying. Like in this circumstance, this hiccup is not a big issue, but it could very easily, you tweak a few of those facts and it could be a real nightmare of a scenario.
I'm going to bring up on the nightmare scenario front, I'm going to bring up a situation or a scenario, and this is sort of changing tone a little bit here, but along the same lines. So one of the things to note in Alberta is with dower rights in Alberta, even if you accumulate or you purchase a property after a separation agreement has been signed, if dower rights were not signed off during that separation time period, you cannot sell or refinance that property until you're legally divorced without permission from your ex. So even if you purchase the property after the separation agreement has been signed, if you try to sell that property a year later or change the financing on it, you still need your ex's permission if you didn't have dower rights signed off in the separation agreement. And this might not come up a lot of times for people who have owned properties previous, because typically if you've owned property previously, dower rights are addressed when you're going through that separation stage, right? But I had a situation, I had a client that it was an abusive situation. They were leaving an ex with a court-ordered separation agreement. This was a situation where it was a bit of an emergency situation to get them into something that they could move into. Money was being, kind of held in parents' accounts and things to sort of help a strategic exit, shall we say. And I screwed up. Like, I didn't know this, and the lawyer didn't advise her of this. And we bought a property. We financed this property. We did 1 year private term financing to get her out of her situation and get her into a house and move on with her life. They didn't previously own. Dower rights were not addressed in their court-ordered separation. And a year later comes up, and this is during COVID. So a year later comes up, and what's the status of her court-ordered divorce? Not in the queue. Courts were what are they processing? They're working on 2019 at this point, right? I don't know. Maybe they're not.
No, they're much better now. But there was a time in COVID where it was crazy. Like it could take up to 3 months to get the divorce, which to me that's crazy.
Well, this is we're in 2023, and this court order divorce is still not finalized.
Well, there's some other. That's not because it's been submitted for filing and it has been filed. It's because there's some other issues there. But your point is still the same and really important, and that is the Dower Act needs to be dealt with, and it doesn't happen that often. Usually, if you have a separation agreement, it's kind of a non-issue because part of the separation agreement is usually one person taking care of the divorce, and the divorce happens relatively quickly, and then dower is not an issue anymore. But if you're in the situation where you don't have a separation agreement or the divorce doesn't happen soon after the separation agreement, which can happen as well, and you don't get a dower release, then you're in trouble. And here's the thing: if you lie, whenever you sell a property in Alberta and there's only one person on title, land titles will not register it without something satisfying the Dower Act. And there's 3 ways that can happen. One is you've never lived on that property's never been the homestead of the couple. 2, you're not married. Or 3, the spouse has provided a release. So one of those 3 things has to happen. There might be others, like there might be another one, but those 3 for sure will satisfy the Dower Act. And some piece of paper satisfying the Dower Act has to go in to land titles if only one person is on the title and they're selling. And so she wasn't able to say, I'm not married. And she may have been able to say it wasn't our homestead, but I don't know. Apparently not, because this is the issue you ran into. Anyways. So what happens if they just kind of lie because, really they're basically divorced? If that were to happen, then the damages are very specific, and it's like there's no fudging it with the court. It's cut and dry in the Dower Act. So if you disobey the Dower Act and you lie and you get something, there's a disposition of land is what they call it, and the person with the dower rights didn't sign off on it, then the amount of damages is equivalent to half the consideration for the disposition made by the married person, if the consideration is of a value substantially equivalent to that of the property transferred, or half the value of the property at the date of the disposition, whichever is the larger sum. So now I'm not an expert on this, but the way I'm reading that, it says to me that if you sell a house for $300,000, it doesn't care about what the mortgage is. You then owe the other person $150,000. Now I could be wrong, and maybe it's the value and the mortgage is taken out of that, but I don't think that's what it says. So I'm not giving a legal opinion about the Dower Act, but the point I'm trying to give is you can be in a lot of hurt And
and so this is something that, like I say, I mean, we found this out a year later, trying to move her out of her private financing into a bank mortgage, and couldn't, because we can't refinance or sell that property without her ex's permission. And of course, getting her ex's permission means he knows her address, and that's something that we, that was avoided in this situation, right?
What happened? I'm on edge.
There's still, and it gets worse, right? She's in private financing on this property.
And so they're done after that year, right? They want their money out.
Well, I mean, they've renewed her.
Okay.
We're at the second renewal. But what were the interest rates like 2 years ago? And what are the interest rates at private financing like today, right?
Yeah.
So this is someone whose mortgage payment has gone up about $400 a month for a single mom with, 3 kids. That, like, is that this isn't the best situation, especially when our plan in the first place was it's a 1-year thing, it's a stopgap, we'll get it moved after, we just need the time, we need the 1 year, that kind of thing, right? So so my comment to this would be, just in tying back to our previous chat on this, is just like, even when you're talking about that separation agreement phase, and you're talking about the plans and moving forward and buying property and being, you can purchase a property with that separation agreement, but you have to know that you better be on amicable terms if you're doing that. And everybody needs to know what the plan is, because if you do want to change your financing or sell and your divorce is not finalized yet, your ex better be willing to come and sign, right? And I think a lot of people I get a lot of phone calls from people who want to purchase a property to run away to. They want to purchase something that they can leave their partner and move into that property. And earlier point, renting's not so bad. Renting is not so bad when you might have to pay your ex out of your property that you've purchased to run away from them to, right? And
So usually if there's a separation agreement, you're going to be fine, because first of all, the lawyer will know. And if they don't know, well, at least if you're listening to this, and so you can tell them. But the lawyer will know, and they will usually get a dower release executed at the same time. But if they don't, for whatever reason, usually there's clauses in there that say, like, in order to give effect to this agreement, you guys have to sign whatever you have to sign. But it's a good thing to be aware of. And the bigger issue is if you don't have a separation agreement, then you could wind up in hot water like this person did without even realizing you're getting into hot water.
Yeah, well, and it's interesting, actually, so after learning that, by making that massive mistake and not ruining this person's life, her life is not ruined.
So Jill, hold on, Jill, you didn't make the mistake. Her lawyer did, and she should actually sue the lawyer. That's not a popular thing for lawyers to say about but like, we have.
I might give her your number because we've talked about that.
Well, I'm not going to, I don't do that kind of law, but she should sue him, because we have liability insurance for that very reason, because lawyers make mistakes. And
we talked about that and said, like, where in writing did they advise you that this was the case? And they said, well, we told you. And if I was a lawyer and I had somebody buying a property in this intermediary time period, I'd probably be making them sign a piece of paper that says they know that, because I feel like that's a big deal, right? And but it's interesting, because you were saying, like, most separation agreements will address this. I had this come up with another client. So a separation agreement, they had never owned property previously. They had, a lawyer drafted separation agreement. She moved into a property that she was renting from, their landlord. And then she wanted to purchase the property off of her landlord. Because she had moved into that property after separation and before divorce, it was considered, they have to check that box. Yes, she's lived in that property. They did not have dower rights, addressed in the separation agreement, because they had never owned property before. Mm-hmm. And the week of closing, everybody's panic, that she's got to find her ex, right? Like, track him down. She hasn't talked to him in 2 years, that kind of stuff, right? She's got to find her ex. He's got to come and sign a piece of paper with a lawyer so that she can buy this house, right? Just tying this all back, there's a lot of situations that can come up when you're dealing with divorce, separation, whatever, that can guide your decisions. And you probably want to talk to your, a lawyer, a accountant, broker, make sure that what your plan is makes sense when you're going through that, because just because you think you're going to go buy a house the week after your separation agreement is signed, I don't know, if your ex doesn't sign, is crazy. If they've dragged out your separation agreement for 6 months because they're fighting over the air miles points, like, are they the kind that's going to sign the dower rights for you and you want to move your
Get divorced.
Yeah.
If you're going to buy a house, get the divorce. You better have that divorce in process. Yeah. Cause you're right, Jill. It's not going to, you can't even sign a dower release for property that's not purchased yet. You can't. So if you haven't bought a property yet when the separation agreement is happening, there's no dower release they can't sign the dower release at the time they're doing the separation agreement because it has to be specifically for that title.
Oh, right. Like, it's not just in general.
Yeah, it's not just a general. Yeah, I don't think land titles would accept like a general dower release. I think it has to be named the dower release form names the specific parcel. So that's a really good point that people need to know. Don't just buy a house if you're separated, not divorced. Or beware if you do that, this can be an issue.
We had one recently that we refused to work on, where a client had contacted us because they had written on a the pre-construction property, put their deposit down, $40,000 deposit down, and then it came time to qualify. And, we're trying to qualify them to close on this, condo a year later kind of thing. And during our discovery of documentation and conversation, it came out that the reason they bought the property was because their accountant had told them to hide money by putting a deposit on a pre-con purchase, and so that they could hide their money from their separation. And we just refused to work on it, right? Like, we're not in the business of helping you hide money from your ex while you're going through a divorce, right? And a situation where a guy did not qualify for this property. They just, and it was like, well, I'm glad you threw $40,000 in a deposit to a builder that you're not going to get back because you can't qualify to close on this purchase because your divorce isn't separated or your separation isn't complete. And the bank won't finance without a completed separation agreement. I hope that was better use of the money than giving 20 of it to your ex and keeping 20, right?
Right. Crazy.
Yeah. And even in that situation, you could have bought it and you probably couldn't have gotten they would have found out about it anyway. So that seems like you're not going to circumvent the law or the rules when it comes to, to divorce, to financing when going through or after divorce, right? So you're not going to circumvent lender rules. You're not going to circumvent the government regulations around purchasing and the documentation that's required or, the law. So I think, keep that in mind when going through that. Everybody listening to this podcast is all on the up and up and good anyway, right?
That's right. Well, we encourage them to be.
Yeah.
Kim, any last questions?
No, I think it's really important to listen to what Jill had to say because we've heard it from lawyers, we've heard it from accountants, we've heard it from almost every single guest who's been on our program. Do not hide money. Do not attempt to, be sneaky with the courts because either the banks will come down on you, a judge will come down on you, somebody's going to figure it out and it's not going to work in your favor. So take the easy route, do the right thing, disclose your financials, talk to professionals everywhere. Divorce really is a collaborative opportunity for people to talk to a whole pile of professionals who have experience. I think it's really important that professionals have experience because, like, to your point, Jill, that was a great learning opportunity for you. And you're probably so grateful that came across because despite it being a hiccup in one spot, it's probably going to help out a lot of other people down the road. And it wouldn't have come up had you on our podcast, probably had you not had gone through this. So we certainly,
I know the GoFundMe. I'm going to open a GoFundMe for the podcast listeners so we can pay off this girl's mortgage because that's how guilty I feel. Right. But yeah,
we've all been there. We've all been young or come across just something that we just would have had no way of knowing. And
no, you're not the lawyer. You're fine.
No, I know. I feel guilty anyway.
No, their lawyer should feel guilty.
a lawyer needs to donate to the GoFundMe, right?
Yeah, you're fine. You're fine. Yeah. She had a right to get proper legal advice as part of that real estate transaction. So,
but I think it just highlights at the end of the day, though, that like you said, ask all the professionals, because there's a lot behind the scenes. Most people, when we think about divorce, when you think about leaving your spouse, you're thinking about who's getting the good couch, who's getting the crappy basement couch. Am I going to keep the bed? Who's taking the pets, right? And where am I going to live? You're not thinking about, the weird letter of the law that's going to have, behind the scenes that might throw a massive wrench into your plans, right? Divorce is an emotional situation, but, finance and the legal side of things, it's not an emotional side. That's not an emotional situation. There are hard, fast rules when it comes to this side. So just because what you want to do fits your emotional needs doesn't mean that it's the right thing to do, right? You got to analyze that with your brain, not your heart.
yeah. Amen.
Well done, Jill. Well done.
Well, thanks for having me on. Like I said, we could just keep talking if you want, but all the listeners, everybody's driven to Banff by now listening to the podcast in the car, right? So
they're ready to go skiing or hiking or whatever they're doing. Yeah.
I was there for 8 years. It's a great place. Enjoy the weekend, right?
And one last thing, Jill. So you're with the mortgage architects, but you've got the mortgage nerd behind you. Is there a significance to the mortgage nerd?
I know I mentioned earlier, I have a team of agents. I actually teach mortgage brokering to new brokers across the country. So I have a underwriter training course, teaching all of this kind of stuff to new agents and stuff like that across the course. So the course is called the Mortgage Nerd. But that's me. It's my sort of nickname, I guess, would be, I'm pretty nerdy about this kind of stuff. So yeah, on top of doing business here, I'm licensed in Alberta MBC. I do have a team of agents across the country. And then I do teach, exactly how to do this job across, to agents across the country as well. So.
Well, that's great. For those listeners who aren't watching this, Jill has a sign in her background that says the Mortgage Nerd. It looks great. It's stylish. There's glasses on it. You'll just have to look it up on YouTube to see. All right, Joel, thanks again so much for coming. I'm sorry Heather couldn't make it. She sends her regrets, but she also promised to take you out for lunch. So.
Oh, I can't wait. We connected pretty well the other day when we were, so we've been talking about that, but yeah, thanks so much for having me. Anytime you want me to come back and talk about anything nerdy, like I'm game. So great.
All right. Well, thanks so much.
Thanks, Jill. It was great to see you again. It's been a while, but how fun is this to connect on the podcast? And we will take you up on that offer.
Yeah. Yeah. And yeah, you and we should go for lunch too.
We should lunch. We should all lunch. That's what we do. We don't work. We just lunch.
That's right.
I said the other day, you can edit this part out. I said the other day in a bio or so, somebody was asking me for like a bio about myself. And I work from home. It's a home office. And I said, I consider getting coffee to be like going out. When we were younger and we talked about going out and it's like a big ordeal or whatever. Right. And so even for I am the person that's at my desk in my office from 8 a.m. till evidently 1 a.m. I am not the person that's like running out. So, Angela's always trying to get me to go to the networking events and stuff like that. And I'm like, that means I have to leave my house. Like I have to go somewhere. I have to, I'd much prefer to just be here in front of my computer, working on mortgages, getting them done than, I'm just not as good at the getting out there, meeting, shaking hands, going for lunches kind of person. Right. But
you do what you like to do.
I know I got to do better at it.
No, you don't have to network. I think you just do what works for you and live the life that you want to live, period.
All right. Well, thanks everyone. That was another episode of Access to Justice. We'll see you next time.
Bye everyone.
Thank you.
Any information in this video is general information only and is not, nor is it intended to be, legal advice. Watching this video does not create a lawyer-client relationship. You should always seek the advice of a lawyer or other qualified professional for advice regarding your individual situation. While we take care to ensure that the information contained in this video is accurate and up to date, we make no warranties or representations as to the suitability, completeness, or accuracy of the information contained in this video. Any reliance you place on the information is at your own risk. Kahane Law Office, Merrick Law, Heather Malarick Professional Corporation, Evan Clark Professional Corporation, Evan Clark, Heather Malarick, and any guests will not be responsible nor liable in any way for any content, including but not limited to any errors or omissions in the content, or for any loss or damage of any kind incurred as a result of any content communicated in this video, whether by Evan Clark, Heather Malarick, or by a third party. Kim McDonald is a financial advisor with Raymond James Limited. Information provided is not a solicitation, and although obtained from sources considered reliable, is not guaranteed. The view and opinions contained in this media are those of Kim McDonald, not Raymond James Limited. Securities-related products and services are offered through Raymond James Limited, member Canadian Investor Protection Fund. Insurance products and services are offered through Raymond James Financial Planning Limited, which is not a member Canadian Investor Protection Fund. Raymond James advisors are not tax advisors, and we recommend that clients seek independent advice from a professional advisor on tax-related matters. Insurance products and services are offered through Raymond James Financial Planning Limited, RJFP, a subsidiary of Raymond James Limited, which is not a member Canadian Investor Protection Fund. When providing life insurance products, financial advisors are acting as insurance representatives of RJFP.
Darkness of the dales dissipates, declines, because of he who turned water into wine.